There's a trader in New York who made $47 million in 2008. You've never heard his name. He didn't short the housing market. He didn't bet against Lehman Brothers. He didn't predict the crash. In fact, he did something that sounds almost insulting when you say it out loud. He did nothing. Absolutely nothing. While everyone else was panic selling, panic buying, refreshing their portfolios every 11 seconds, he sat there. And when it was over, he was richer than almost everyone who tried to be smart. This isn't a story about laziness. It's about something much stranger, something that Wall Street doesn't want you to fully understand because if you did, a lot of very expensive people would be out of work. Right now, at this exact moment, there are probably a dozen investing apps on your phone telling you to do something. Buy this stock, sell that one, rotate into bonds, get out of bonds. The message is always the same. Action equals intelligence. Sitting still equals missing out. And it makes sense, right? If the market's moving, you should move with it. If things are dropping, get out before it's too late. If things are rising, get in before you miss it. That's not investing advice, by the way. That's just how it feels when you're holding money and watching numbers change color on a screen. But here's the thing. The data suggests the opposite. The people who do the most tend to make the least, and the people who do the least, who actually commit to doing nearly nothing, often end up ahead. Not sometimes, often. Which sounds wrong. It sounds passive. It sounds like you're being told to ignore a fire alarm. But stay with me, because what's about to unfold isn't about being lazy or delusional. It's about understanding a truth that the financial industry has spent decades trying to bury under noise. Let's start with a number. The average investor, according to a study by Dalbar, underperforms the S&P 500 by about 4% per year. 4% doesn't sound catastrophic, but compound that over 20 years and you're talking about hundreds of thousands of dollars left on the table, sometimes more. Why? Because people trade, they move, they react, they think they're being smart, and they're often being precisely the opposite. Here's how it works. You buy a stock, it goes up, you feel like a genius. It goes down, you feel like an idiot. You sell, you wait, you buy something else. Maybe it works, maybe it doesn't. Either way, you're moving, you're engaged, you're doing something. And every time you do something, you're paying. You're paying trading fees, even if they're small. You're paying taxes on short-term capital gains, which are higher than long-term. You're paying in time, in emotional energy, in the cognitive load of constantly making decisions. But more than that, you're paying in opportunity cost, because while you're out of the market waiting for the right time to get back in, the market keeps moving. And it turns out, most of the market's gains happen on a very small number of days. Miss the 10 best days in the market over a 30-year period, and your returns get cut nearly in half. In half! And here's the problem. Those best days often happen right after the worst days. They happen during crashes. They happen during chaos. They happen exactly when your brain is screaming at you to sell everything and hide. So if you're moving in and out, trying to time it, trying to be smart, you're almost guaranteed to miss those days. And missing those days doesn't just hurt, it destroys your long-term wealth. Let me tell you about Fidelity. In the early 2000s, Fidelity did an internal review to figure out which of their clients had the best returns. They wanted to know what the top performers were doing, what strategies, what sectors, what secret moves were working. And what they found was absurd. The best performing accounts were the ones belonging to people who had forgotten they had accounts, dead people, and people who thought they had closed their accounts years ago but hadn't. These people did nothing because they couldn't do anything. They weren't reading the news. They weren't checking their balance. They weren't calling their advisor in a panic when the market dropped 8% in a week. They were just gone. And their portfolios quietly compounded in the background, untouched, unbothered, growing. Now, Fidelity didn't publish this as an official study. It floated around as an internal insight, then became an industry legend. But even if the details are murky, the lesson is sharp. The act of doing nothing, of not interfering, of not trying to outsmart the market, can outperform almost every other strategy. But why is this so hard? Why does doing nothing feel so unnatural? Because humans are wired for action. We're wired to solve problems, to avoid danger, to move when things feel uncertain. Sitting still while your portfolio drops 15% in a month feels like watching your house burn down. Your brain interprets it as an emergency, and in an emergency, doing nothing feels insane. There's also the issue of ego. Doing nothing doesn't make you feel smart. It doesn't give you a story to tell at dinner. You can't brag about the trade you made, the call you got right, the move you executed perfectly. Doing nothing is boring, and boredom in a world that rewards spectacle feels like failure. Then there's the industry itself. The entire financial ecosystem, from apps to advisors to cable news shows, is built on the premise that you need help, that you need to act, that you need someone to tell you what to do next. If the message was just buy index funds and stop looking at your phone, there'd be no ads, no subscriptions, no commissions. The system requires you to believe that action is necessary. Otherwise, the system doesn't get paid. So you're fighting biology, ego, and capitalism all at once, and most people lose. Let's zoom in on a specific moment. March 2020. The pandemic hits, markets collapse. The S&P 500 drops 34% in about 5 weeks. Fastest crash in history. Every headline is apocalyptic. Every chart looks like a cliff. If you were watching your account, you saw red. Deep, violent red. And millions of people sold. They pulled out. They went to cash. They thought they were protecting themselves. They thought they were being rational. But by August, the market had fully recovered. By the end of 2020, it was hitting new highs. And the people who sold in March were still sitting in cash, waiting for another crash, waiting for confirmation, waiting for safety. They missed one of the fastest recoveries in modern history. Meanwhile, the people who did nothing, who stayed invested, who maybe didn't even look at their accounts, came out fine, better than fine. They captured the entire recovery without lifting a finger. This happens over and over. In 2008, in 2001, in 1987, the pattern is the same. Markets crash, people panic, people sell. Markets recover. The people who sold are still on the sidelines, confused, angry, poorer. Now, let's talk about the math behind this. Why does doing nothing actually work? First, markets go up more than they go down. Over the long run, the direction is up. Not every day, not every year, but over decades, the trend is clear. The S&P 500 has returned about 10% annually over the past century. Some years more, some years less, some years deeply negative, but the average is up. If you're in the market doing nothing, you capture that average. If you're moving in and out, you're trying to beat that average. And beating the average is hard. Professionals with teams of analysts and algorithms can't do it consistently. The idea that you, checking your phone between meetings, can do it better is statistically laughable. Second, compounding requires time. The longer you stay invested, the more your returns start to curve upward. The first 10 years might feel slow. The second 10 years start to accelerate. The third 10 years, if you're lucky enough to have them, can look almost magical. But only if you stay in. Every time you pull out, you reset the clock. Third, taxes. If you hold an investment for more than a year, you pay long-term capital gains, which is lower. If you sell before that, you pay short-term, which is taxed as ordinary income. For someone in a higher bracket, that's a massive difference. Trading frequently means paying more to the government. Doing nothing means keeping more of your returns. And fourth, behavioral protection. The biggest risk to your portfolio isn't the market. It's you, your emotions, your fear, your greed, your need to feel smart. Doing nothing removes you from the equation. It takes your worst instincts offline. But let's be honest, this all sounds great in theory. In practice, it's almost unbearable. Imagine it's 2008. You have $300,000 in your retirement account. Over the course of a year, it drops to $150,000. Half. Gone. You wake up every morning and it's worse. Your friends are selling. The news is saying it's going to zero. Your spouse is asking what you're going to do. And your strategy is to do nothing? To just sit there and watch it burn. That's the test. That's the entire game. Because if you can sit through that, if you can hold through the absolute worst moments without flinching, you win. Not immediately, not emotionally, but mathematically over time, you win. The people who sold in 2008 locked in their losses. The people who stayed got back to even by 2012 and went on to capture one of the longest bull markets in history. Doing nothing isn't passive. It's an active choice to ignore every instinct telling you to move. It's discipline disguised as inaction. Now, let's talk about the uncomfortable part, the part that makes this strategy feel incomplete. Doing nothing works if you're invested in something that goes up over time. Index funds, diversified portfolios, broad market exposure. But if you're holding individual stocks, if you're in speculative plays, if you're chasing hype, doing nothing can destroy you. If you bought Enron and did nothing, you lost everything. If you bought Pets.com in 1999 and held, you got wiped out. Doing nothing only works if what you're holding has a reasonable chance of surviving and growing. So the strategy isn't just do nothing. It's own the right things, then do nothing. And that's where people get tripped up. They hear this advice and think it applies to whatever they're holding. It doesn't. If you're sitting on meme stocks, crypto gambles, or companies with no earnings and no plan, doing nothing is just slow motion losing. The real strategy is simple, almost boring. Buy a low-cost index fund, something that tracks the entire market. Then stop looking, stop trading, stop thinking you're smarter than the system. Just let it sit. But that's not exciting. It doesn't feel like winning, and so people ignore it. Here's another angle: the opportunity cost of doing something. Every hour you spend researching stocks, reading market news, watching financial TV, that's time you're not spending on your career, your business, your skills, your relationships. For most people, the return on investing that time into themselves is far higher than the return on trying to beat the market. If you're a software engineer, spending 10 hours a week learning a new framework or building a side project will probably make you more money than spending 10 hours a week trying to pick the next Amazon. If you're running a business, focusing on your customers will generate more wealth than obsessing over your brokerage account. The irony is that the best investors, the ones who actually get rich from the market, are often the ones who ignored it. They build companies, they create value, they earn, they save, they invest, and then they move on. The market is a tool, not a game. But we've been sold the idea that investing is supposed to be engaging, interactive, thrilling. It's not. It's supposed to be boring, and boring works. Let's zoom out. What does all this mean for someone watching this right now? If you're young, in your 20s or 30s, the math is absurdly in your favor. You have time. Time is the single most valuable asset in investing, and you have decades of it. If you start now, invest consistently, and do nothing else, you'll almost certainly end up wealthy. Not because you're smart, because you're patient. If you're older, in your 40s or 50s, the principle still applies, but the margin for error is smaller. You can't afford to panic sell and miss recoveries. You can't afford to sit in cash for years waiting for the perfect moment. The best move is still to stay invested, stay diversified, and let time do the work. And if you're near retirement, doing nothing becomes even more critical, because the worst thing you can do is blow up your portfolio trying to make up for lost time. The safe, boring move is usually the right one. Here's the part that no one wants to say out loud. The financial industry doesn't want you to do nothing. They want you to trade, to upgrade, to switch strategies, to hire advisors, to pay for premium tools, because all of that generates revenue for them. The average expense ratio on an actively managed mutual fund is around 1%. Doesn't sound like much, but over 30 years, that 1% fee can cost you nearly a third of your total returns. A third. Gone. Not because the fund performed poorly, but because you paid someone to try. Meanwhile, a low-cost index fund charges about 0.03%. The difference between those two numbers, compounded over decades, is the difference between a comfortable retirement and a struggle. The entire pitch of active management is that experts can beat the market, and sometimes they do, for a year, maybe two, but over the long run, the vast majority of them don't. Study after study shows that passive investing outperforms active investing after fees, And yet, billions of dollars still flow into actively managed funds every year. Why? Because doing nothing doesn't feel like enough. Because we want to believe someone out there knows something we don't. Because we've been conditioned to think that more effort equals better results. But in investing, more effort usually just equals more fees. So what's the move? What should you actually do? If you don't have investments yet, start. Open an account. Buy a total market index fund. Set up automatic contributions. Then forget about it. If you're already invested but you've been trading, stop. Seriously, stop checking your account every day. Stop reading articles about the next hot stock. Stop trying to time the market. You're not going to win that game. No one does. If you're sitting in cash because you're scared, get back in. Not all at once if that feels too risky. Dollar cost average over a few months. But get in, because every day you wait is a day you're not compounding. And if you're already doing nothing, if you've been sitting in index funds for years and ignoring the noise, congratulations, you're ahead of most people. Keep going. Here's the uncomfortable truth that ties all of this together. Doing nothing isn't really doing nothing. It's about doing something once correctly and then having the discipline to not undo it. It's about ignoring the part of your brain that thinks movement equals progress. It's about accepting that in this one specific domain, effort and results are inversely correlated. It's about trusting a process that feels wrong, especially when the market is collapsing and everyone around you is panicking. And it's about recognizing that the real skill isn't picking stocks or timing crashes. The real skill is doing absolutely nothing when every fiber of your being is screaming at you to do something. That trader in New York who made $47 million in 2008, the story's probably exaggerated. Maybe it didn't happen exactly that way. But the lesson is real. The people who survive crashes aren't the ones who predicted them. They're the ones who didn't react to them. Because in the end, the market doesn't care about your fear. It doesn't care about your strategy. It doesn't care if you're watching or not. It just keeps moving. And if you can learn to move with it by not moving at all, you'll end up somewhere most people never reach. The question isn't whether doing nothing works. The data is clear. It does. The question is whether you can actually do it. Whether you can sit still while the world burns, whether you can ignore the noise, the fear, the hype, the experts, the apps, the news, all of it. Most people can't, and that's why most people lose. But maybe you're different.